Editor-in-Chief Emeritus and opinion columnist Matt Winkler. You have a lot of data in this column that I think is worth getting through because it's not just the CPI and the PPI data, it's also the break-evens that are telling you that traders are seeing more ahead in terms of inflation.
Right. The bond market, the U.S. bond market, is $30 trillion. It's the market that tells every other market what to do. It's not ideological. It's simply looking for relative value, what's cheap, what's expensive. And what it's telling us is that for the first time since Donald Trump as president said he had COVID along with his wife Melania back in October 2020, the bond market is saying inflation 2 years out is going to be higher than where inflation is today. And as I said, we haven't seen that since 2020. So you have to go all the way back to Donald Trump's first term. The entire 4 years of Biden, every single measure in the bond market showed inflation abating 2 years out.
So you gave a list in this column that I think is really worth keeping attention on because it's everything from potential inflation to tariffs to also hints that you point out from Trump that the U.S. might no longer honor its full faith and credit. Of the pieces on this list, which concerns you the most?
Well, they're all part of one word, which is the definition of Donald Trump as president: chaos. His whole agenda the past 25 days has been nothing but chaos. And markets actually don't thrive when there's a lot of chaos. And that's where we are right now.
But do you think that it's the inflation story here or the other parts of his agenda? You talk a little bit about the siphoning of money from certain agencies. For example, we have a budget deadline that's around the corner as well. A lot of investors keeping an eye on the term premium in addition to other parts of the bond market. How big of an issue is simply the budget?
Well, all of these, if you like, policies that have been articulated, all of these events that we've seen are essentially attacking the full faith and credit of the United States. And that's why the bond market is reflecting that turmoil.
When you think about that full faith and credit of the United States, there are two camps of people. The people that believe that DOGE would create a significant dent in spending, and the people who believe that there's no way to make that dent, DOGE or no DOGE, right? Where do you stand in that spectrum?
Well, first of all, the federal workforce is tiny. It's actually smaller than what it was 35 years ago when Bloomberg News began. So the notion that you're going to cut somehow federal workers as a way to trim the deficit is absurd at this point. The only way you can actually trim the deficit significantly is if you raise taxes on the wealthiest Americans. That would be billionaires, of course, and that's not where they want to go.
When you think about the components of the bond market, and you look at many in the course of your column, what are the numbers that are most stunning to you based on the reaction we've seen in the early weeks of the administration?
So one of the most proficient users of the Bloomberg terminal is my colleague Shin Pei. And what he is able to show us by just using the Bloomberg terminal is that in the bond market, if you look at, you mentioned it before, break-even rates, but not just for 2 years. If you look at break-even rates for the 10-year maturity of securities, you look at break-even rates for the 30-year maturity, they're all saying the same thing at the same time right now. And we haven't seen that in quite a long time. We didn't see it last year. Last year, the bond market was quiescent, relatively speaking, certainly going out into November last year. So this is a departure from the stability and the tranquility that we experienced last year.
Certainly a lot of investors on edge as inflation is a bond market's nightmare. Don't miss this column. Of course, the world's most important market sends a warning. That is Matt Winkler. We thank you very much. That is Bloomberg's Editor-in-Chief Emeritus. Now, for more on markets and how they're handling inflation, as we've been talking about, we're joined by Kathryn Rooney Vera. She's Chief Market Strategist at Stonex Financial. Let's talk more about this dynamic, because at some point that bond market havoc, if you will, it's been very volatile under the hood, is going to impact stock market performance. But at what levels do you think that would happen at more?
Well, I think if we get some sort of trade war, then that would inherently affect multinationals, which are a very high weight in the S&P 500. So a strong dollar, high tariffs, that would certainly affect multinationals. But maybe I'll add to what your previous guest was talking about. I think it's an interesting point. A couple things. I think one, there are ways to get deficits in line without soaking the rich, and I would suggest reforming entitlement programs would be one of those. And in fact, the U.S. government, in terms of federal and state employees, is the largest employer in the country. So it's pretty relevant, 20 million plus people. And I would add a final point, Shanali, which I think is particularly interesting, which is my contention is that the U.S. Treasury yields are moving higher, not because of chaos or Donald Trump, but rather because I think we're at the end of secular stagnation or this global savings glut. Larry Summers called it secular stagnation. I think it was Greenspan called it the savings glut. Investment now as a percentage of global GDP is very high. It's at the highest we've seen, 27%. And I think that the fiscal past, the profligacy past, the bond markets have up to this point given the government has come to an end. So my suspicion is that term premium and the 10-year yield move higher if we don't get spending under control and if the size of government is not decreased. So for that reason, Shanali, I think that poses probably the biggest threat to the equity market. So yes, tariffs are a threat. We saw in 2018 with Trump 1.0, we've seen this movie before. Tariffs were imposed, far fewer than what he had threatened. But we saw in 2018 about an 8% drop in the S&P 500. We can expect a similar occurrence, but I would argue that if we have a blowout of the fiscal deficit, that's even worse than across the board tariffs affecting multinationals.
Well, it's interesting. It's a risk that I think a lot of people don't quite understand what the ultimate ripple effect will be. I go back to Ed Yardani's note over the weekend where they say that right now it's not an imminent issue, but they say to ask again if the yield jumps above 5% with attendant widespread fear that it's heading towards 6%. Now, that kind of 5% level, at least in the near term, there are more and more investors voicing fear around that level. I can't imagine what 6 would mean. What would 6 mean?
Yeah. Look, I think there's a very good chance, Shanali, that we hit. We're at 4.5 now. We probably break 5 at some point in this year. And I think there's a real threat of 5.5%. If we hit 6, then we're talking, in my opinion, I think we see a meaningful correction in the U.S. equity markets because, of course, then equity risk premium pales in comparison to what you can get for a risk-free asset. So when you're talking about exposure, and I travel all over the world, I've been at Stonex now almost 2 years, and I've done 50 trips. When I talk to international institutional clients, Shanali, it's fascinating because you can talk to life insurance company, pension funds, inherently risk-averse investors, and these guys are long dollar assets. They're long equities. They're long tech. They don't want to hear my thoughts on how to protect profits. They want to hear about what are the next Mag 7, what's the next big thing. So there's, in my view, a big potential for a correction, and that's why I'm recommending investors protect their profits, not liquidate them, because I do think that this year is going to be a good year for the U.S. economy, not a bad one, but protect those positions. And there's a lot of interest in private credit. There's inordinate interest in alternatives, and that's because the 60-40 correlation between stocks and bonds has wholesale gone out the window. So
I want to double down on the point you're making about the next Mag 7, because if you look at the Mag 7 performance this year, it's been sluggish at best. You have the NASDAQ 100 largely outperforming what you saw in the Mag 7. It's up more than 5%, beating out most major indexes, but you also still have a lot of the high flyers in that index flying high through the course of last year, too. So pretty bid up. Palantir's the best performer this year. Constellation's the 3rd best performer. Does that worry you, the concentration risk, even outside the Mag 7?
Well, there is concentration risk in tech as a sector, and that's why I recommend buying protective puts on the technology sector. So I do think there's a risk there, especially if we do effectively get into a trade war. Then industrials and tech are, I would think, the most vulnerable. And I'll add to that, it does concern me because if I'm right and we get a reacceleration of the U.S. economy and potential overheating of the U.S. economy, remember, Shanali, this is the 4th consecutive year, if my estimates are right, and the U.S. grows 2.3% or more. This will be the 4th consecutive year of above trend growth with a positive output gap. That in itself is inherently inflationary. And the sectors that are most vulnerable to still high rates, or even, God forbid, the Fed having to resume hiking rates, is effectively tech. So I do think there's opportunities to reallocate assets to potentially underperforming sectors or defensive sectors. And if we get an all boats rise year, then I think you should be in healthcare. I think you should be in utilities, which was my top pick last year and a very top performing trade. I think you should be in staples, more domestically oriented sectors.
Kathryn, we thank you so much for your time today. That is Kathryn Rooney Vera with Stonex.